The investment map nobody showed you in school, safest to riskiest explained. What's up, everyone? Welcome back to the channel. Quick heads up before we get into it, nothing in this video is financial advice. I'm not your advisor, I'm not a licensed broker. I'm just someone who's obsessed with how money works and wants to break it down in plain English. Today we're covering the full landscape of investing, every major type of asset, what it actually does, who it's for, and what the real risks are. No jargon. No textbook definitions. Just the truth about where money goes and why. By the end of this video, you'll know more about investing than most adults twice your age. Let's go. Here's the one rule that governs every single investment on Earth, and I mean every single one. Are you ready? It's almost too simple. More potential reward always equals more risk. Always. That's it. That's the whole game. And yet, most people spend their entire lives trying to find the loophole. The hot stock tip. The can't miss crypto. The real estate deal that's basically guaranteed. They're searching for high reward with low risk, and that thing does not exist. It has never existed. And every time someone promises it to you, they are either lying or they're about to lose your money. Now here's where it gets interesting, because risk isn't just one thing. Most people think risk just means, I might lose money. That's part of it. But let's break it into 4 types, because understanding this changes everything. Type 1, volatility. This is how much an asset bounces up and down. Bitcoin might be up 40% in March and down 35% in April. That's high volatility. A savings account. Almost zero volatility. The number barely moves. Type 2, drawdown. This is the gut punch number. It's how much you could lose if you bought at the worst possible time. The S&P 500 dropped about 50% in 2008 and 2009. Meaning if you put in $100,000 right before the crash, you watched it become $50,000. That's drawdown. And knowing that number matters, because a lot of people say they can handle risk until they see their account cut in half. Then they panic sell and lock in the loss. Type 3, time horizon. Here's the one most people ignore, especially beginners. Volatility is way less scary the longer you hold. If you put money in the stock market for 30 years, short-term crashes become irrelevant noise. But if you put money in the stock market and need it in 2 years, now that volatility is a real, serious problem. Time changes everything. Type 4, liquidity risk. This one's sneaky. Some assets look valuable on paper but are really hard to convert to cash quickly. Real estate is the classic example. You might own a house worth $400,000, but if you need $20,000 by Friday, good luck. You can't sell a bedroom. Liquidity matters more than most people think, especially in an emergency. So before you invest a single dollar into anything, ask yourself these 3 questions. How much could I actually lose? How long can I leave this money alone? And what happens if I need this cash in an emergency? Those 3 questions will protect you more than any financial advisor. Alright, let's build the map. Think of all investments as a pyramid. The base is the widest, the safest, the lowest reward. As you climb toward the tip, the risk goes up, the potential reward goes up, and the number of people who actually belong there goes way down. The base, capital protection at the very bottom, you've got assets that are basically just about not losing money. Cash. High-yield savings accounts. Money market funds. Now I know what you're thinking, that's not investing, that's just saving. You're right. But it serves a purpose. This is your emergency fund. This is the money you need if your car breaks down or you lose your job. 3 to 6 months of expenses, sitting somewhere safe and accessible. Not in the stock market. Not in crypto. Somewhere you can get it in 24 hours without penalty. High-yield savings accounts right now are actually paying decent interest. Shop around and you can find accounts paying somewhere around 4 to 5% annually at some online banks. It won't make you rich, but it won't blow up either. This layer isn't about growth. It's about foundation. The lower middle, government bonds and treasury securities, one step up from savings. You've got government bonds. When you buy a U.S. Treasury bond, you are literally loaning money to the United States government. They promise to pay you interest and give your money back at the end of the term. For most people, that's about as safe as investing gets. Now, the returns aren't wild. We're talking maybe 4 to 5% on short-term treasuries right now. But here's what most people don't realize: bonds are not boring. They have a role. They're the ballast in a portfolio. When stocks crash, bonds often hold steady or even go up. That's called negative correlation, and it's why a portfolio of 100% stocks is actually riskier than a smart mix of stocks and bonds, even though stocks have higher individual upside. There's also a special type called TIPS, Treasury Inflation-Protected Securities. These are designed specifically so inflation doesn't eat your money alive. Think about it this way: if inflation is running at 6% and your savings account is paying 1%, you are losing 5% of your purchasing power every single year. TIPS adjust with inflation so that doesn't happen. Not sexy, but important. The middle, corporate bonds and dividend investments. Now we're moving into the middle of the pyramid. Here you've got corporate bonds, basically the same concept as government bonds, except you're lending to companies instead of the government. Companies like Apple, Johnson & Johnson, or Walmart. Here's the key difference: companies can go bankrupt. Governments, especially the US government, basically can't. So corporate bonds pay more, because you're taking on more risk. Investment-grade corporate bonds, meaning the financially strong companies, are still pretty conservative. But there are also high-yield corporate bonds, Wall Street's fancy way of saying junk bonds. These are companies with shakier finances, so they pay higher interest to attract lenders. Think of it like a friend who's not great with money asking to borrow cash. You might say yes, but you'd charge more for the risk. One real-life way a lot of everyday Americans get bond exposure without picking individual bonds. Bond index funds. You put your money in, and the fund spreads it across hundreds or thousands of bonds automatically. Much easier, much more diversified. The upper middle, real estate. Let's talk real estate, because this is where a lot of Americans feel most comfortable. And for good reason: it's tangible. You can drive by it. You can see it. It feels real in a way that stocks don't. But here's what a lot of people miss: real estate is a moderate to high-risk investment, not a safe one. Property values fell 30% nationally during the 2008 financial crisis. Landlords deal with vacancies, bad tenants, leaky roofs, and rising property taxes. And unlike a stock, you can't sell 10% of your house if you need quick cash. That said, real estate done right can be incredibly powerful, especially when you factor in rental income, leverage, and tax advantages. The key phrase there is done right. Location, timing, financing terms, and local job markets all matter enormously. Two investors can buy houses on the same street in the same year and have completely opposite outcomes 5 years later. For people who want real estate exposure without actually buying property, there are REITs, real estate investment trusts. These trade like stocks and let you invest in portfolios of commercial real estate, apartment buildings, warehouses, hospitals, you name it. They're required by law to pay out 90% of their income as dividends, so the income can be solid. But they're also volatile like stocks, especially when interest rates rise. Okay, we're climbing to the top of the pyramid now. This is where most people get into trouble, because this is also where the exciting stories come from. The guy who turned $10,000 into $1 million on Tesla. The person who bought Bitcoin in 2015 and retired by 2021. These stories are real. But for every one of those, there are thousands of people who lost everything chasing the same trade 2 years too late. Stock index funds, the everyday person's best friend. Let's start with the most important asset class for most Americans, broad stock market index funds. An index fund is a basket of stocks designed to mirror the market. The S&P 500 index fund, for example, holds tiny pieces of the 500 largest U.S. companies. You buy one fund and you're instantly diversified across 500 companies in dozens of industries. Historically, the U.S. stock market has returned around 10% annually on average over long periods. Some years it's up 25%. Some years it drops 30%. But over decades, the trend has been up. Warren Buffett himself has said that most Americans would be better off just buying and holding a simple index fund than trying to pick individual stocks. The catch: you have to actually hold it. During COVID in 2020, the market dropped 34% in about 5 weeks. People who panicked and sold locked in massive losses. People who held, or better yet, kept buying, saw the market fully recover within months and go on to hit all-time highs. The hardest part of index fund investing isn't picking the fund. It's staying calm when your account is down $40,000. Individual stocks, higher upside, higher risk. Now, one level up from index funds, buying individual company stocks. This is where it gets more personal and more dangerous. When you buy one company's stock instead of 500, your success is tied entirely to that one company's performance. Pick right and the returns can be massive. Someone who bought Amazon stock in 2010 and held for a decade turned $1,000 into about $17,000. But someone who bought Enron, Blockbuster, Kodak, or Bed Bath & Beyond, all companies that looked solid at one point, watched their investment go to zero. Concentration risk is real. Most people don't have the time, expertise, or emotional discipline to research and monitor individual stocks at a high level. That's not an insult, it's just reality. Even professional fund managers, on average, underperform simple index funds over 10-plus-year periods. Let that sink in. The extreme end, leveraged funds, options, crypto, and speculation. All right, we've reached the tip of the pyramid. This is the territory where you can 10x your money, or lose everything in 48 hours. Not exaggerating. Leveraged ETFs are funds that use borrowed money to amplify daily market returns. A 3x leveraged S&P 500 fund goes up 3% when the market goes up 1%. Sounds great, right? Except it also goes down 3% when the market falls 1%. And because of how compounding works in volatile markets, these funds can bleed money even when the market is flat, a phenomenon called volatility decay. These are genuinely dangerous instruments for anyone who doesn't understand them deeply. Options and futures are contracts that bet on where a price will go. Used by sophisticated traders and institutions to hedge portfolios, they can be incredibly powerful tools. But for most beginners, they're more like a casino than an investment. You can lose 100% of what you put in, and in some cases, you can actually lose more than you invested. Hard pass for the average person. Then there's crypto. Look, I'm not here to trash it. Crypto is real, Bitcoin is real, the blockchain technology has real use cases. But let's be honest, this is one of the most volatile asset classes ever created. Bitcoin has dropped 80% from its peak multiple times. Altcoins have gone to literal zero. Regulatory risk is still massive. There's no earnings report, no dividend, no fundamental anchor for value the same way stocks have. This is a speculation play, not a saving strategy. If you're putting your retirement fund in crypto, I'm genuinely worried about you. Okay. So you've seen the whole map. Now here's the real question, what do you actually do with this? Here's how I'd think about it in 3 buckets. Bucket 1, protection, 10 to 20% of your money. This is your emergency fund plus some stable assets, high-yield savings, short-term treasuries, maybe some tips. This money has one job: be there when you need it. Don't try to make it grow. Just don't let it disappear. Bucket 2, growth, 60 to 80% of your money. For most people, this is mostly low-cost broad market index funds, US stocks, maybe some international stocks, maybe a bond mix depending on your age. This is the boring, consistent, decades-long wealth-building engine. Automate contributions. Don't check it every day. Don't panic sell. Just let time do the work. Bucket 3, speculation, 5 to 10%, max. This is the fun money. Individual stocks you believe in. A small crypto position. An alternative investment that interests you. The golden rule here: only put in what you could afford to lose completely and still sleep fine. This bucket is not your retirement. This is a calculated bet. Here's what changes the game: diversification across buckets and across asset types. The whole point is that when one thing goes down, because something always goes down, something else in your portfolio is either holding steady or going up. You're not betting everything on one outcome. You're building a system that can survive any outcome. One more thing. The biggest wealth destroyer for most Americans isn't a bad investment. It's timing. People invest when the market is hot and pull out when it crashes. They do the exact opposite of what works. The antidote. Automate it. Set up automatic contributions every month regardless of what the market is doing. This strategy is called dollar cost averaging, and it removes emotion from the equation entirely, which is honestly the best thing you can do. If this video clicked for you, if something here changed the way you think about money, drop a comment below and tell me which part hit hardest. Was it the risk types? The pyramid? The 3-bucket system? I read every single comment. And if you know someone who's either doing nothing with their money or gambling it away on hot tips, share this with them. Genuinely. This could be the video that changes their financial life. Hit subscribe if you want to keep building real financial knowledge in plain English. Next week, we're going deep on index funds, the exact strategy, and the common mistakes that kill your returns without you realizing it. You don't want to miss that one. See you then.